Everyone, welcome back to the channel. Today we're going to take a look at GameStop. Recently their stock has kind of shot up like crazy if you've been following them at all. I'm going to kind of take a look and see what's really going on there and see if we can't explain it and come to a price target. So first I'll show you, we'll just pull up GameStop real quick on Yahoo Finance. You can see, so I guess they're down 9% today. If we look at them year to date, you know, they were $4 or $5 a share, so they're still up almost 400% here. So I went ahead, I've already pulled in the financials. If you're new to the channel, I'm not sure where those come from. Let me pull this up real quick and I'll show you. Head on over to sec.gov, more search options, GME, and then you can filter for 10Ks and 10Qs. So I actually went back to the 2010 one, I believe, or maybe 2011. Wanted to pull some more data here just for some historical trends, and I'll kind of go over that so you can see I just pulled top line and then through SG&A here for them for some of the older years. The reason I did this is I want to kind of see when the last new gen consoles came out and how they perform the next year or the next following years, to see if it really, if this year is going to be any different with the release of the new Xbox and new PlayStation. So first, what we'll do, we'll come over here to the DCF. So I've just linked this all up for those of you that are new. This is kind of the DCF template. You got revenue, COGS, gross profit, SG&A, D&A. That'll get you into your EBITDA, and then less D&A gets you the EBIT, adjusted EBIT when you do tax rate. So here we just used 21%. Obviously I think it was like 28 or something prior to 2019, but the historical years don't matter as much. Then you get to an unlevered free cash flow. You can see projections right now is negative, and we'll kind of go through some of these assumptions and see the valuation we're getting for the company and all of that. So first we'll rework some of these. So historically, CapEx has been around 1 to 1.3% of revenue. So I'm just going to leave that flat. D&A recently has been above 100%. That means they're not. They have no growth CapEx. So in theory, if they are to remain a company and stay around, they're going to have some growth CapEx. So then depreciation won't be 100% of CapEx, because every year there will be new additions other than just maintenance. So I have this slowly kind of decreasing down to about 80% and then holding constant there. Working capital doesn't seem to be too much of a thing for them, so I've just kind of, to be honest, held it flat to this year's. And once we link that up, it'll all come through here. But right now the revenue numbers aren't, revenue's being held flat. So we'll get that linked up here in a second. And actually that's the wrong formula. There we go. So I guess first what we want to do is look at sales growth. So we can see over the last few years, and I have it on the income statement tab as well, and here's the growth rates. Historically, I mean, pre them filing for bankruptcy almost, I mean, they were growing at low single digits, if not slightly negative. So it wasn't exactly a high growth company to start with. And then in 2017, you can see it's just kind of the start of the downfall. 2019, I believe in 19 they closed a bunch of stores, so that really highlights that. But I guess the issue here is you close a bunch of stores, but your SG&A percentage is shooting up, so they weren't really clawing back their SG&A at the same rate as store closures, and you really see that in 2020. They're going to have roughly a 30% decrease in sales. Q4 right now is projected. So I just projected this as, look at Q4 of, these should say 19 over here, not 20. But looking at how Q4 of 19 was of the total year, just use that to forecast out Q4 here. So, I mean, they're on track to decrease 30% again. We're just kind of holding COGS. COGS has historically been in the 70%, it's holding it there. And then SG&A, you can see, I mean, it used to be, what is it, 16, 18, 18, 19, 20. And as the years go on, it just, they're not controlling their spend. Their costs keep going up while their sales are coming down. So something was out of line here. And you can see, like, I mean, SG&A in 19, 1.9 billion compared to 2 billion. So, I mean, it's down a little bit, but your sales are down $2 billion. Like, your sales are down, what, 30% there, 20%. You should be cutting this by 20%. This should be like 1.5 billion. What I'm seeing in 2020 should be here in 19, and maybe there's severance or something that accounts for that. But even here, right, SG&A is 36%. So let's go to the DCF. Let's tweak some of our assumptions and see what we can kind of get to. And we'll kind of run a couple scenarios, a best case and a worst case. So first, sales growth. And, let's assume, and if we look here, when new gen consoles come out, I mean, it doesn't have a massive boost to their sales. It's not, a slight uptick, but they were down from 2012 to 2013. So I wouldn't expect there to be just this massive ramp up from these new systems. So if anything, I'm going to assume they're done closing stores, and they're going to be able to just kind of maintain, if not slightly decrease, close a few more stores. They're going to be able to maintain close to where they are today in sales. And we'll do this as kind of a first. So we'll give them, we're going to say, they're going to keep closing some stores and have them decrease 5%. We'll do that for a couple of years. And then we'll have them go to 0. And I think in this scenario, this is actually like the rosy scenario. This is the good scenario for them. COGS historically have always been around 70%. So I'm just going to link this to 72% for now, and we'll see what we kind of get here. And now SG&A, this is the big thing. Are they going to be able to claw this back and get back to, I mean, if we look historically, right, COGS was 16, 18, it was, right around high teens, 20%, and then it just explodes here. So this is our rosy scenario. So we're going to decrease them at 5% a year until we get back down to the low 20s, and then we're just going to hold it. And I think you'll see in this scenario, this explains why their stock has been exploding. If we hold this scenario constant and we say that this is the real scenario, right? We come over here now, we look at this, we're saying 10% cost of capital. So if we wanted 10% return, we could even say, I mean, look, GameStop's risky, like, right? They might go bankrupt. We need a 15%. We need a 25% return, right? Or let's go 20%. Let's start there. If we need a 20% return, then the NPV of their cash flows is 800 million. Assuming that, they can stop the decline in sales and just be a steady state company off their current stores and do the same volume every year. And they can get SG&A back in line. Terminal growth rate, 3%. That's pretty standard. Keep it close to inflation. So then that gets you a terminal value of 1.7 billion. NPV that gives you 300 million. Enterprise value, 1.1 billion. Net debt, if you're not familiar with this, this is just off the balance sheet. This is going to be your debt less your cash. So if we come here, you'll see liabilities. And I'm just using 2019 as a proxy here. And I ignore operating lease. That's like a new accounting change recently. But if we go here, long-term debt, 419, and then subtract out their cash of 500, they have 100 million more cash than debt. I think that's a good sign, honestly, assuming they can pay their lease obligations, if we're ignoring that. So that's actually positive for them. So that's giving them an equity value of 1.2 billion. And based off their current share count, they have about 70 million shares outstanding. That give a $16 share price, and that would get you a 20% return on your investment. So, I mean, let me close out of that wrong browser. If we look here, right, they're trading at $19. So, if you only required a 15% share price, you're going to say, hey, they're undervalued right now. They were 24 bucks a share at a 15% return. And I mean, if you treated this like a regular blue cap 10% return, it's a $40 stock price. You'd be willing to pay up to $40 for this. It's a steal. Now the question is, with these new gen consoles, and since they've already done a lot of closings of stores, what's the future really hold? Are they really going to be a 30% decrease for the next few years until they're doing $1 billion in sales or something? And then from there, do they then just kind of slowly decrease until they're going to die, and they decrease 5% a year or something? And in that case, and it's just like slowly going until they bleed out, and the company's gone and they're not going to be able to control SG&A. It's going to actually increase as sales continue to go down. It's going to go up, 3% a year or something until it hits 50% of sales, and then it's going to maintain flat. See, in this scenario, which I think is probably more likely with the way the industry's shifting, you can see very quickly this company isn't worth anything, and has no value at all. So the big question here is, they signed a new agreement with Microsoft this year. Is that going to help them, right? Are they going to be able to start selling Microsoft products through their store? I don't know. Hopefully. And then games have completely shifted to digital. You don't go into the store anymore to buy a game and then go sell a used game. That was a big portion of their revenue. That's gone. You buy everything through the online marketplace, through Xbox or PlayStation or Nintendo. So the used game market's gone. They're not selling like hard copies anymore. It's all digital. Sure, they get a big spike on like midnight release and limited editions, but there's only so many games a year that really drive that kind of traffic. And if we take this scenario and say, hey, look, we're gonna give them some credit here. They're gonna die, but it's gonna be a slow death, and they're gonna scale back SG&A, right? Well, okay, now they're a $400 million company with a $5 share price, and if we actually look at this, right, year to date, I mean, that's kind of where they were. People were like, we think you're going to continue to crater top line as this industry just fundamentally changes. You're going to be flatlined, and then we'll give you some credit. We're going to say you're going to just do a massive reorging over the next few years, and you're going to get your costs back in line. And you're going to scale back after some high years here of unprofitability. You'll just become this kind of medium, just kind of crappy run rate company. So yeah, I mean, then you get the 400 million. Realistically, the story here is just how do you see the future of their industry? Are the Walmarts, the Targets, the Best Buys? No, Best Buy has research back. Have they taken away the channel for buying when you're going to go buy a video game? They're now the place you're going to go because there's a Target, a Walmart, a Best Buy in every city, and there used to be a GameStop in every city, but now that they've closed thousands of stores or half their stores, how many ever it is, there's not a GameStop everywhere. So you go to Target, you go to Walmart, you go to Amazon. So it's really going to be a story of their e-commerce and their partnership with Microsoft, if they can kind of rebrand themselves into more than just a game store. So yeah, I mean, there it is. That's a pretty quick valuation. Hope you guys found this useful. I think their story might be better than we think. I think Q4 will be really telling this year when they release that in February. If they have a strong Q4, that could show that maybe they've kept the right stores open. The new gen console might actually kind of keep them alive, and if they could do some things to stay relevant, maybe they can, stay competitive in the marketplace. And maybe right now they're actually pretty fairly valued at $1.3 billion market cap. It'll be interesting to see, but it's been interesting to see their run up recently. But I guess if you just have a slightly positive picture here, you can actually pretty easily get to that valuation, which is kind of surprising compared to some of the other stocks right now when you look at the Teslas, the Palantirs of the world that are just kind of running up with no rhyme or reason. So I hope you found this useful. Thanks for tuning in. If you have any questions or comments, leave them below. Thanks. Appreciate it.